Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about inflation, a possible recession, new listings, and chaos agents. Logan, welcome back to the podcast.
Sarah, it is 9 degrees here in Boise, Eagle City.
That is a long way from Southern California.
No. I got up really early and then went to the gym, and then I opened the door just to see, I was like, oh Lord, I'm going to become one of those White Walkers in about 10 seconds. So hopefully it heats up just a little bit before I go do my speak.
Yeah, no, I mean, you're used to that Southern California weather. You're spoiled.
No, 68 is freezing for me. 9, no.
That's a lot. Well, we have a big day besides you speaking. We have, it's inflation day, right? So what do you expect to happen?
Yeah, so it's Tuesday morning. We're talking to, of course, CPI report is going to come out Wednesday, and then the PPI inflation is going to come out on Thursday. Jerome Powell is going to be talking to Congress. So it's interesting because we have a little bit of divergence between some of the Fed presidents, which isn't odd, where Waller, who used to be the hawk, was kind of saying, hey, listen, we could have 4 rate cuts, this year. And Neil Kashkari, we all love Neil, was even talking about, maybe more rate cuts happening in the second half of 2025. I'm imagining that we talked about how much the disinflation we saw on the BLS rent index. And, the CoreLogic single family rent index was at the lowest level in 14 years. So I think some of the Fed presidents are kind of all in on this CPI inflation, having some disinflation after the, pricing adjustments we see. A lot of companies, they up their pricing for goods and services the first part of the year, the first few months, and that gets adjusted to the CPI inflation. The Fed kind of knows this, so it's a little bit hotter early on than the second half. So it'll be interesting to see what the rent is. This podcast will come out just about the same time as the CPI inflation and how the bond market reacts to it. But I would imagine that some of the Fed presidents are really counting on that, assuming that, there is no trade wars or pricing hits from that going out in the second half, and use that because, to be honest, if you have 1% rate cuts into the system, 65 to 75% of the 10-year yield mortgage rates still revolve around the Fed and policy inflation. If that could come down, the base is a little bit lower. And like I said, all you need is 6% mortgage rates. You could get things going. It's a little bit more plausible to have that backdrop if that's occurs. So that last 1%, which means neutral, maybe 3.5%, that's what it is. This is all based on the labor market not breaking. If it broke, it would be rates would go lower. But in this context, you could kind of see the frameworks toward the end of 2025 if this disinflation from rents continues.
I think what always strikes me when we talk about the market moving or how this goes is just the long tail of everything. So you just were talking about that, and then you're like, so by the end of this year, we might see, and I'm like, no, I want something to happen faster than that.
Well, so let's review. When has mortgage rates gone lower? Mortgage rates started to go lower. We wrote about that article in 2022, right? The next move in rates is going to be lower because there was so much market stress back then in 2022 that the next move lower, the 10-year yield from 4.25 got all the way down to 3.37. The Gandalf line was created. We're not breaking underneath this. So that was market stress, fear of a recession, the Silicon Valley banking crisis, all those things. Scare, right? Economic scare. Then last year, right, how mortgage rates got down to 6%, better spreads, right? The story, so much of the mortgage rate story is the spreads in 2024, 2023, and 2025. But back then, the labor market was getting softer, wasn't breaking, but the Fed started cutting. They're like, oh my God, we were too restrictive, and then it stopped, right? The economic data started getting better, so the Fed's like, okay, we'll go back to being our old ways. So Mortgage rates have only moved lower on economic scares or labor scares. That's it. Where the 10-year yield as of this morning was 4.53, right? Where Fed policy is, where growth and inflation is, that is a very, very reasonable 10-year yield. Mortgage rates are elevated because the spreads are not back to normal. But if you just had normal spreads, a lot of the housing issues would kind of go away. But until then, that last mile, assuming that the labor market is still intact, you could start to create a plausible lower rate premise that can work with the housing market without the labor market breaking. And that's kind of the next stage of how we're going to talk about economics, over the next 2 to 3 years, assuming that the labor market isn't broken. If the labor market breaks, doesn't matter. 10-year yield goes ahead of the Fed comes after. That's a whole different story. But hypothetically speaking, if the labor market doesn't break, how do you get 6% mortgage rates to stick there? You get 1% more rate cuts, you get a little bit more dovish Fed. You could stick in those areas for longer.
Well, let's talk about the labor market breaking, because one of the wild card things about this administration is they're really looking to cut government jobs. They already have cut some government jobs. It seems like they are seriously cutting other government jobs. At what point does that play into the labor market breaking?
So it's interesting. Kevin Hassett, who's the head of the Economic White House Council, I think he made a statement on CNBC that he said, we want to create the labor supply to grow and lower aggregate demand. Everyone went bat crazy when he said that, because it sounds like the White House was talking about a recession. However, I was trying to explain to people, this is exactly what Jerome Powell was talking about in 2022 and 2023. We need more labor supply and lower aggregate demand. So there's nothing different about that. I think, and we joked on Twitter. Remember when you and I talked about this weeks ago and said that what if the White House's plan is to lay off all the federal workers and cut spending, right? Draw money out of the economy, which will lower growth, right? And that's how you get, rates to go lower. But Treasury Secretary Bassett was like, we really want the 10-year yield to go lower. But now that is a plausible case. The only thing is that federal workers, you can't lay off all the federal workers. Okay, that's just not feasible. Majority of government workers are state and local. We're talking teachers, firemen, police, so it's not a big enough pool. Just think about, like, there's over 162 million people working. Like, it's 1% of the workforce that's federal, so, but anything that creates a labor supply to grow, it would be that. There's the buyouts, are these people going to get laid off, or is it an 8-month buyout, so, but that's where it looks like it's going. If it's fire, they're going to get jobless claims. Jobless claims would rise. But again, we've never had a recession because government workers lost their jobs.
This might be the first time.
They're just not big enough unless you start firing, police, fire, teachers, firefighters, everything. It's just not that big of a. I mean, think about this. Manufacturing actually lost jobs last year. And it was 87,000 jobs that were lost. Not big enough, right? We had a manufacturing recession in 2016. Oh, the PMI recession bears. Those were the days, Sarah. You didn't know me back then. I had so much fun in 2015, 16. Oh, the memories. We're a consumption-based economy, so as long as the consumer spending, the aggregate demand is still there. So we'll see. But it was just like, somebody tagged me and sent it to Doge and go, oh, this is what you guys want to do. I was like, no, we're not. We even talked about that. Maybe we shouldn't say this because Musk might take that as a plan. But you really need lower demand if you really want to talk about a wave of jobs being lost like we've seen in every single recession post World War II. Federal workers just aren't big enough.
Okay.
Unless you like fire them all at once, no buyouts and jobless claims would rise. It's just not for a local economy, maybe DC, but
I think though that when you think about like say the NIH cuts, right? So that affects jobs all over the country at different research facilities. It affects hospitals. It affects things like that. And so it feels like that could have that kind of thing. So that's not really cutting the labor force. I mean, it's really cutting funding to a bunch of other people.
well, if you're talking about the second or third effects of withdrawing money out of the system, that's different than that. That's the take the money out of the circulation. If you wanted to lower aggregate demand by cutting spending, then that's taking money out, right? And then unless you're like doing something to offset that, that has the circulation of less dollars impact. That's the second thing that Hassett talked about. We want to lower aggregate demand. The way he said it it sounds so dark that everybody went there, but it's really what Jerome Powell was saying for so many years. We want higher labor supply and lower aggregate demand.
So, in your opinion, whether it's Powell, whether it's the new administration, do we have to have a recession to reset? Is that what people
You
are
don't
thinking?
you do not need to have a job loss recession to bring down the growth rate. Oh, wait, it already happened. The growth rate of inflation has already gone from, we were at what, 9% CPI, 7%. We're basically, if I took the CPI inflation data, we're basically at the averages we've had since 1913. Okay, so you don't need to create a recession. That's a fabricated myth, right? We already did it. And not only did we not do it, we did it with growth above trend. See, this is how stupid the whole conversation was. People said you have to create a job loss recession to bring the growth rate. Growth rate of inflation came down with the labor market outperforming and also growth above trend for still running into 2025. So we get into this political ideological discussion, which I've always hated, but this is where we're at right now. Do you really need to withdraw spending and fire people to bring the growth rate of inflation even lower, to bring rates lower? This is what we're talking about because this is what's being discussed out in public. So we already see some of that coming out of the system. We need to see what the effects of it going out for the economy. But remember, we're still having deficits, right? We're still spending trillions of dollars. You have to outweigh the consumption-based economy, how the economy is doing on that front, then the business investments going out there, and then, how much money is circulating through the government. And remember, majority of all, spending is mandatory payouts. Social Security, Medicare, net interest cost, right? Then defense spending. All this other stuff is not in the big scale things, unless you just completely wipe it out overnight. Not as important as the U.S. consumer. But that's where we're heading. So it'll be a good test to see the second, third effects of taking money out of the system that were tied to government programs.
When do you start to see that as far as in the economy, the second, third effects? So so we've, it's a lot of uncertainty because there have been freezes and then there have been, judgments, from judges and lawsuits to say, no, you can't do the freeze. And then there's a question on like, has the freeze really been unfrozen? Like, these are not clear things at this moment.
When jobless claims start to rise in direct relationship to the money being taken away, there it is. I mean, it's going to be very clear cut and simple. If you need X amount of dollars to keep this program going and it's gone, you lay those people off. So you'll start to see it in regionals, right? I think the governor from Alabama was like, wait a second, Alabama, the university, they need the money for the state because that's the largest employer. So you want to look at states that are tied to employment. If I don't believe they're going to cut the funding for Alabama because that's a red state, but that would be a prime case if that would occur going out. But it's not so fast unless you just fire people, right? We're not talking about buyouts, but firing government workers. Then you see the jobless claims pick up.
So we will keep an eye on that. I mean, early, and you've made the point often that, Trump likes to talk a lot of things. What is he actually going to do? But one of the things he talked about before and after the election and after the inauguration is like, there's going to have to be pain, but that's okay. The consumers will understand, and there's going to have to be pain. So, no one really knows what he means by that. Like, does he want a recession? Does he want a mini recession? Does he want to, what does that mean?
It's not Trump that people should kind of be mindful of. It's Musk.
Right.
Because Musk is when there's an agent of chaos, but when there's two agents of chaos,
there are two agents of chaos.
Then you just, who's watching the watcher here? We'll be able to track it very quickly if something happens to that degree, but we're just not sure. I mean, things could be bogged up in the courts for a long time, but again, if there's a whiff of economic weakness, 10-year yield, bond market will get ahead of it. Bond market has tried to get ahead of it twice now, actually 3 times, to be honest with you. And if it doesn't, if it holds true, the 10-year yield will go down. Treasury Brissett will get what he wants. The Fed would have to follow with rate cuts. We're not there yet, but we're keeping an eye on this. And for example, last night Trump talked about tariffs, steel.
Yep.
Put it on, but March 12th,
right?
So a lot can happen between now and March 12th. So hopefully by now, we're again another example. If he really wanted to have a tariff economy, you would just put it in place. That's it. Let it go. No negotiation. Years and years and years of trade wars and tariffs, and what do we have to do? And then we have to create an economy where we build a lot of stuff here. So far right now, just like in 28, tactical trade war, parts and pockets and countries, but in the big scale terms, I think one of the differences now compared to 2018 and 19, if he goes through with a lot of these tariffs and keeps it in, it's a broad basket of things that, in a sense, all the items that were tariffed back then, prices did increase. But in scale terms, it didn't matter to the inflation data. Inflation data was still, running on trend. So this is just how it's going to be, and we're just going to have to take it. But again, now we have another date, March 12th, right? So it's not conventional, but we've done this before. We just have to take it one day at a time and see what the effects are.
Okay, so there's Donald Trump levying tariffs, President Trump levying tariffs. There's China levying tariffs on us, right? So hit the home builders again, because we have aluminum and steel, I believe. Some of those materials, China has said they're not waiting for Donald Trump to back down. They're like, well, here's our tariffs.
We have leverage over everyone because our economy isn't based on trade as much. This is why I always say that nobody really wants a trade war, because we're a consumption-based economy, and these other countries, trade to them matters more. And we just don't have the backdrop to produce a lot of these things here in the U.S. and keep it cheap, right? So that's just the reality of the world is. And, if we're destroying other economies and then we're going to tell these economies to buy stuff from us, and while all dollar gets strong, it defeats the purpose. This gets into a very complicated discussion, but it's the reason why I don't believe we're going to see trade wars. It doesn't benefit anyone, advantage, disadvantage, unless you have something set up, which might take about 8 to 15 years to try to set up here in the U.S. And with political cycles running every 2 years, it's something where Republicans and Democrats and independents all have to come together and actually agree on something, because it's going to be a material change. And it always goes back to the dollar is just simply too strong for us to be an exporting country. And we just don't have an effective way to lower the dollar without actually, either cutting rates to zero or having some kind of weakness in the economy.
If you're a home builder out there and you're like, kind of the whiplash of all of these sort of tariffs, not tariffs, tariffs being put on hold, now tariffs from China. I mean, do you just simply go, I'm just going to take a step back, kind of see how this shakes out?
Well, the builders have already taken a step back. Permits are at recession levels. So it's not like, it'd be one thing if mortgage rates were at 3.5% and new home sales were like booming, but the, the builders right now have this issue. Higher rates impact them, right? Supply, units completed is rising. Existing supply is rising. The South, where they've put so much of their construction, is at a weak spot. Then, on top of all that, you have to think about, okay, well, is my material cost going to go up?
Right.
Right? On construction costs, let's say with the tariffs, it would be like 5% increase on construction costs. That hurts my margins. So the builders have gotten away with a lot of things because their margins were good, right? And that margin is starting to compress a little bit lower, and its demand's not there. It's just it reminds me again of what happened in 2018 and 19. What happened in 2018, business investment went down to zero because companies didn't know what the rules were. So you're it's just one of these things that it is what it is, but you want business to have a little bit more clarity on what's happening. And when it's chaotic like this, they don't know. But the builders were already at a problem before this. So you could see why the Home Builders Association said, hey, listen, can we not have the tariffs now? So they're in a little bit more of a predicament than other sectors of the economy has. So you could understand why on a Friday night they sent that letter.
Oh, yeah.
Saying that. But this is the economy we have. This is the White House we have. We just have to take it one day at a time. And today, Jerome Powell is going to talk to Congress, and we'll see what he says. And we got to deal with it. And it's going to be much different than what we had in the last 4 years.
Well, and that's a great segue into my promo for our Housing Economics Summit, which is in 2 weeks, 2 short weeks. We are gathering some of the best economic minds in the country all in one day to talk about every part of the economy. I mean, we're going into not only, mortgage rates and inventory and home prices, but insurance and the fires and what this new administration means for people in housing, whether that's real estate or mortgage. So, we just tell everybody, if you haven't made your plans yet, we're getting close to selling out. Get your plans to meet us in Dallas on February 26th.
But by that time, we'll have a really good idea about the spring. And I would tell you this one thing about the tracker this last weekend. The new listings data is not as strong as I want it to be at this point. Last year, and we always highlight this, 80,000 to like 110,000 seasonal peak weeks, right? New listings is very seasonal. That's normal. We have not even breached above 80,000 the last 2 years. We did it in 2020, 2020, or 2021 and 2022. Wasn't a lot. It was just barely above 80. But the last 2 years have been the lowest new listings ever. So this year I was like, okay, I got it wrong last year with 75,000 was the peak, but I said we're going to get 80,000. It was such a noticeable drop off in new listings that, it made me question, am I going to be wrong again? So that's something we're keeping an eye on. Again, you could have active inventory growth. That's what we've seen, right? We're not mortgage rate lockdown people. Are we mortgage rate?
I'm a mortgage rate lockdown.
Okay, you're a mortgage rate lockdown. If you look at our inventory data, you've seen whenever rates are elevated, mortgage demand is suppressed, inventory has been able to grow on our weekly data. So we're there, but the new listings data, most sellers are buyers. We need that to get back to normal, or even above 80,000. So that was the disappointing thing that I saw in the tracker. Everything else for me looked fine. In relationship to where rates are, because you have to get some kind of benefit that rates are this elevated. If rates are elevated and inventory isn't growing, this is why I hated 2023. Like 2023 was just like, oh my God.
Everyone hated 2023. Everyone hated that year. It was terrible.
Yeah, but it was just like prices grew above my, what our comfort level in. Home sales were at record low levels. That was just like hideous. But you have to get some kind of benefit for keeping home sales depressed and inventory growth, right? So we're getting more choices. But we need to have the new listings data pick up, because if that doesn't go, we're just working with the product that's out there. So on that benefit side, price growth is slowing down. Again, I was wrong last year. My price growth forecast was too low, but it sets up for a better backdrop when rates do fall. The outside concern, this is like so far out there, is that when you keep sales depressed for so long and you have 162 million people working, you don't want it to be a situation where rates just drop really fast.
Right.
And all of a sudden, everyone's like, oh my God, I've been waiting to, move on this. And then you just get a, kind of that rush. This is why I don't want a recession, because in a recession, rates go down, faster than what people, and then I kind of
we're back to then we're back to 2021.
No, we're not going to be back to 2021 because inventory is higher and rates are elevated, right? Unless, if inventory was at 2020 or 2021 levels and mortgage rates were at 3%, yes, but we're not there. But there's an equilibrium on each side where, team higher rates February of 2021, we're like, hey, we need higher rates. And the argument against that was the unemployment rate's at 6%, we can't do that. Okay. But here on the other side, there's a counter argument. If you don't allow some of that pent-up demand to kind of just get into the system, then you're creating a kind of a rush. If you do let things get to the point to where it's a recession, if it's a recession, then the Fed can't do anything. Bond yields go down, it goes lower for faster. And even though that benefits housing people, right? For me, it's like, you're starting to lose that equilibrium balance. And that's the complicated part about housing economics for me in general, because everybody cares about prices. Price to me is a net negative unless if it goes above trend. You want a functioning, slow and steady housing market. Millions of people buy homes. People have choices. They don't have to worry about, multiple bids or, it's just the normal process. And that's the backside of my mind is thinking, if this goes on longer, every year these traditional buyers that would be here are waiting. And then if something breaks, the rates go down lower. We always talk about my army is bigger than yours, right? COVID-19, why was I talking about, hey, wait till about May, things will look better. And people go, well, there's 20 to 30 million people unemployed, Logan, right? Who is going to buy homes with 20 to 30 million? And then I said, oh, that's cute. You're all cute people. There's 5 million in forbearance too. But you're forgetting about the 133 million people behind me. My army's bigger than yours. Now it's 162. So I'm just trying to find that equilibrium balance. And the fact that new listings data didn't grow as fast, it just, makes me focus a little bit more that am I going to be wrong again? Am I not going to get 80,000 in the new listings data, which we got in 2021 and 2022 plus that. So something that by the time our Dallas event is, we'll have a really clear picture of a lot of things. That's why it'd be good for going into spring.
Looking forward to that. We are out of time. Thank you so much, Logan, for being on today, and we will talk to you again soon.
Pleasure.
Stay warm in that 9-degree weather.
Yeah. I'll try my best.
Okay. Talk to you later.